Hello everyone, welcome to Tesla Daily News. Today is May 30th, Saturday, and the following is the latest Tesla news. According to market data, Tesla shares closed at $435.79, down from the prior close of $442.10, after trading between an intraday high of $441.07 and a low of $428.14 on volume of about 45 million shares. Technically, the stock posted a red day below prior resistance, signaling short-term weakness after failing to hold the 440 zone and slipping toward recent support in the high 420s, with elevated volume suggesting active positioning by both bulls and bears. According to TechCrunch News, the most consequential development for Tesla investors today is the new Texas Department of Motor Vehicles autonomous vehicle registration data, which shows just how small Tesla's Texas Robotaxi footprint is compared with Waymo and other players. Under a law that took effect May 28, companies testing or deploying autonomous vehicles in Texas must disclose fleet counts and safety information. Waymo has registered 577 autonomous vehicles in the state, Ride comes in with 317, Nuro with 47, and Tesla has registered only 42 autonomous vehicles, despite a robotaxi launch in Austin last summer and announced expansions to Dallas and Houston. This data confirms that, at least in Texas, Waymo is clearly dominating the autonomous vehicle registration leaderboard, while Tesla remains a relatively small player in Robotaxis by fleet size. TechCrunch mentions that these numbers do not necessarily reflect how many vehicles are active at any given moment, and that some competitors, such as Nuro and Zoox, are not yet operating commercially. Even Waymo has paused some operations in Texas cities this month due to issues handling floods. Still, from an investor perspective, this is the first reliable public benchmark of relative scale, and it highlights a gap between Elon Musk's ambitious robotaxi narrative and Tesla's current operational presence in a key, business-friendly, U.S. state. For long-term shareholders who are banking on autonomy and robotaxis to justify Tesla's valuation, this Texas data is a sobering reminder that execution and fleet build-out still lag well behind the rhetoric, while Waymo quietly accumulates a very large footprint. According to Business Insider, similar Texas DMV registration records underscore the same message. Nearly a year after launching its robotaxi pilot in Austin, Tesla still has only 42 vehicles on the road in the state, far fewer than Waymo's 577-vehicle Texas fleet and even behind Ride's 317 and Nuro's 47. Business Insider notes that Tesla's pilot began with invited users in Austin, and, although the vehicles are meant to be fully self-driving, the company initially kept employees in the front passenger seat as additional safety monitors. Tesla's vice president of AI software, Ashok Aluswamy, has said that some Austin robotaxis are now operating without a human chaperone, with a mix of supervised and unsupervised vehicles expected to evolve over time. Business Insider mentions that Tesla claims its robotaxi service is also live in parts of Dallas and Houston. In contrast, Waymo entered Texas later, launching its own driverless service in Austin through an Uber partnership in March of last year and then expanding across Dallas, Houston, and San Antonio before temporarily pausing rides due to flooding concerns. For investors, this article reinforces the notion that Tesla's actual robotaxi deployment is still very limited, especially when stacked against a more mature, safety-focused competitor like Waymo. While Musk has often promised hyper-exponential growth and very rapid scaling, the hard registration numbers in Texas show that Tesla is still in the very early stages of building a meaningful robotaxi network. According to the Star, further DMV data confirms the same Texas picture. Tesla operates only 42 robotaxis in the state, while Alphabet's Waymo commands a fleet of 577 automated vehicles, more than 13 times as many as Tesla. The Star highlights that these new registration rules provide the first concrete, official assessment of the scale of Tesla's Texas robotaxi network, which started in Austin last June and has since expanded to Dallas and Houston. The article reminds readers that Musk had previously said he expected 500 robotaxis in Austin alone by the end of next year, but that those expectations have been scaled back. The Star mentions that Texas until now had relatively light oversight of autonomous vehicles, mainly requiring cameras, insurance, and traffic law compliance, but now demands fleet counts and detailed guidance for first responders. From a stock perspective, this third Texas-focused report does not change the numeric picture but adds credibility. When multiple independent outlets all point to the same official fleet numbers, it becomes harder for markets to dismiss Tesla's current robotaxi scale as a short-term quirk. Investors who priced in very aggressive robotaxi revenue contributions over the next few years may need to temper expectations or lengthen their timelines, especially given the size of Waymo's head start in Texas alone. According to Reuters reporting carried by the Telegraph India, Tesla's internal AI trainers and data labelers have revealed major gaps between the company's public claims about full self-driving safety and autonomy and the technology's actual performance today. Reuters interviewed 9 former data labelers and a former self-driving engineer, who say that, even in recent months, FSD has struggled with basic maneuvers such as reliably reacting to emergency vehicles, stopping correctly for school buses, handling construction zones, and safely avoiding pedestrians and animals. These labelers regularly reviewed crash and near-miss footage from Tesla vehicles, including clips where cars hit cats, dogs, or deer without braking, or came dangerously close to children in the street. According to Reuters, Tesla CEO Elon Musk has repeatedly promised that FSD will soon make all Teslas fully autonomous and has touted internal statistics claiming FSD is up to 10 times safer than human drivers. However, a detailed Reuters examination of Tesla's methodology, combined with interviews with traffic safety researchers, suggests that these safety claims are inflated and sometimes rely on invalid comparisons. For example, Tesla compares FSD crash rates that trigger airbag deployments to a broader federal crash rate that includes many less severe accidents, effectively making Tesla appear safer by comparing a narrower, more serious subset of Tesla crashes with a larger pool of all kinds of crashes for other vehicles. Reuters mentions that when more appropriate apples-to-apples comparisons are used, Tesla's operating with driver assistance systems like FSD and autopilot appear to be roughly 3 times better than average, not 10 times better. And even that improvement may be overstated once you adjust for the fact that Teslas are much newer than the average US vehicle, and new cars across the industry come with more advanced safety features. The investigation also notes that Tesla counts only crashes that happen with FSD on or within 5 seconds of it being turned off, whereas US regulators require automakers to consider incidents within 30 seconds of deactivation. For investors, these findings raise both reputational and regulatory risk. If the U.S. Federal Trade Commission or other regulators decide that Tesla's marketing of FSD is misleading, the company could face enforcement actions, fines, or new disclosure requirements. Investors should also consider liability exposure. FSD and autopilot are already under multiple National Highway Traffic Safety Administration investigations, including cases involving fatalities, red light failures, and turning into oncoming traffic. Any future high-profile accidents could further damage consumer trust and slow adoption of paid FSD packages, undercutting one of Tesla's most important high-margin software revenue streams. Reuters also contrasts Tesla's closed-door approach with Waymo's. Waymo publishes data and safety analyses in peer-reviewed venues and carefully matches its driverless robotaxi crash data to human-driven traffic in the same local conditions. Tesla, by comparison, publishes headline safety ratios without peer review and keeps its underlying crash data secret. For Tesla bulls who view the company primarily as an AI and autonomy leader, this gap in transparency and methodological rigor is a key strategic risk. Over time, regulators, insurers, and sophisticated fleet buyers may gravitate toward companies that provide stronger, independently vetted safety evidence. According to Latestly, Elon Musk has shared a new video on social media showing a Tesla Cybercab robotaxi autonomously driving itself out of the Giga Texas factory on May 28. The footage features the Cybercab, a purpose-built robotaxi platform unveiled in late 2024 that is designed with no steering wheel and no pedals, navigating the factory environment without human intervention. The post has generated significant excitement among Tesla fans, who view it as a milestone toward fully autonomous vehicle production and deployment. Latestly mentions that the Cybercab is intended to form the backbone of Tesla's future dedicated robotaxi fleet, distinct from the current strategy of enabling existing Model 3 and Model Y vehicles with FSD. By showcasing a driverless Cybercab moving autonomously inside the factory, Tesla is signaling progress not just on software, but on integrated vehicle design optimized for autonomy and on higher levels of automation within manufacturing itself. For investors, this sort of controlled demonstration should be interpreted as an RUD in branding milestone rather than proof of imminent broad-scale commercial service. From a valuation perspective, the Cybercab concept remains one of the more speculative elements of the Tesla story. The upside scenario is enormous, a large global fleet of purpose-built robotaxis generating high-margin recurring revenue. But the downside is that regulatory approvals, safety validation, and large-scale deployment could take much longer and cost much more than the most optimistic projections. The contrast between this polished factory video and the hard Texas DMV data on actual robotaxi fleet size highlights that, while Tesla continues to push compelling demos and prototypes, investors should still anchor expectations on real-world deployments and regulatory progress. According to multiple Texas registration reports summarized earlier, the Cybercab demonstration also underscores a key strategic question. Will Tesla focus on scaling dedicated robotaxi hardware like Cybercab, or will it prioritize turning the installed base of Teslas into de facto robotaxis via software? The answer has big implications for capital expenditures, margins, and competitive positioning with players like Waymo, which already run large, fully driverless fleets using purpose-designed vehicles. According to the Times of India, Tesla has made an aggressive pricing move in the Indian market by revising its Model Y lineup and introducing a much more affordable entry variant. The company has launched the new Model Y premium rear-wheel drive at an ex-showroom price of about 50,89,000 rupees, while discontinuing the higher-priced long-range premium RWD variant that had cost over 67 lakh rupees. This effectively represents a price reduction of more than 10 lakh rupees for the entry point into the Model Y range in India. The Times of India notes that Tesla will now sell a simplified two-variant Model Y lineup in the country, the 5-seat Model Y Premium RWD and the 6-seat Model Y L Premium all-wheel drive. The newly launched base variant is positioned as the most accessible Tesla in India, undercutting the larger 6-seat Model Y L by roughly 11 lakh rupees. Deliveries are scheduled to start from July 2026, giving Tesla a defined window to ramp up logistics and local support. According to The Hindu, which also reports on the same launch, the Model Y premium rear-wheel drive in India offers up to 500 km of WLTP-rated range and can accelerate from 0 to 100 km per hour in about 5.9 seconds. Inside, it features a larger 16-inch touchscreen with updated user interface, an all-black interior theme with an optional Zen gray finish, and around 2,138 liters of cargo space with power-folding rear seats, accommodating up to 5 occupants. Tesla is pairing this product move with financing designed to lower the barrier to ownership. Customers can purchase the Model Y Premium RWD with monthly payments starting at roughly 39,990 rupees, assuming a 6 lakh rupee down payment. The Hindu mentions that Tesla has also activated its home charging program across all Indian states, aiming to support convenient charging at residences. In addition, the company continues to offer the Model Y L 6-seater in India, which delivers up to 681 km of WLTP range, 0 to 100 in 5 seconds, and up to 2,539 liters of cargo space, with pricing starting near 61,99,000 rupees. Tesla executive Isabel Fan emphasized in comments to The Hindu that Tesla intends to keep investing in India with more retail coverage, after-sales services, and charging locations. For investors, this dual-source coverage of the same event signals a meaningful strategic push into one of the world's largest and fastest-growing automotive markets. The big price cut and financing support are clear indications that Tesla is willing to trade some per-unit margin for volume and market share in India. Over the medium term, if Tesla can build a strong installed base there, it could unlock future software and services revenue streams, including potential FSD subscriptions once regulations allow. However, the near-term impact on global earnings is likely modest given the early stage of Tesla's Indian operations, and investors should watch carefully how quickly Tesla can scale local infrastructure and how demand responds to this more accessible pricing. According to Blick in Hungary, Tesla is recalling more than 14,000 Model Y vehicles in the United States due to a missing regulatory label that specifies critical weight and load information. The U.S. National Highway Traffic Safety Administration has stated that 14,570 Model Y units are affected because the required weight specification certification label was not affixed to the vehicles. While this may sound like a minor paperwork issue, regulators warn that, without accurate weight and payload information, owners may unintentionally overload their vehicles. Blick mentions that overloaded vehicles can experience significantly altered driving dynamics, degraded braking performance, and reduced stability, raising the risk of road accidents. Tesla will address the problem by contacting affected owners and, at no cost, inspecting the cars and attaching the missing labels. From an investor viewpoint, this recall appears to be relatively low cost and manageable, involving no major hardware redesign or complex software fix. However, it adds to the cumulative pattern of Tesla recalls and regulatory interactions that investors should track, as each additional incident can incrementally influence public perception and regulatory scrutiny of Tesla's quality control. For long-term shareholders, the key to interpreting this type of recall is to distinguish between structural, safety-critical design flaws and procedural or documentation issues. The label-related recall is not on the same level as a braking or steering defect, but it still highlights the importance of robust compliance processes as Tesla continues to scale volume across multiple factories and markets. According to the overall news flow today, Tesla's narrative for investors sits at the intersection of two very different realities. On one side, we see the aspirational vision, Cybercab prototypes gliding out of Giga Texas on their own, ambitious robotaxi timelines, and a deeper push into major international markets like India with more accessible pricing and expanding charging infrastructure. On the other side, we see hard data and critical investigations, Texas DMV fleet numbers that place Tesla far behind Waymo in autonomous vehicle deployments, and detailed reporting that questions the rigor and transparency of Tesla's FSD safety claims. For stock investors and Tesla enthusiasts, the takeaway is to balance excitement about Tesla's long-term AI and autonomy potential with a clear-eyed view of current execution, regulatory risk, and competition. Watch the Texas fleet counts, regulatory investigations, and real-world robotaxi availability as leading indicators of whether the autonomy story is turning into durable, revenue-producing reality. At the same time, keep an eye on how quickly Tesla can turn emerging markets like India into meaningful contributors to volume, brand strength, and, eventually, software-enabled profits. Thank you for listening to today's Tesla Daily News. If you found this episode helpful, please subscribe and share it with other Tesla followers and investors so you never miss an update.